Hi, everyone. Mark Yaxley here. Welcome back to Inside the Vault. Today's episode is dedicated to the subject of inflation. We're going to be talking about the causes of inflation, the effects that it's having on mainstream investors, and most importantly, what you can do to protect your portfolio in a highly inflationary environment. Today's guest is Rodrigo Gordillo. He is the president and portfolio manager from Resolve Asset Management in the Cayman Islands. His firm has been very successful providing their clients with actively managed portfolio solutions designed specifically for inflationary periods. He also happens to be a subject matter expert on the subject of inflation, having grown up in Peru in the late 1980s and 1990s when they suffered from hyperinflation. Rodrigo joins us today from the Cayman Islands. Rodrigo, we're very excited to have you here with us today. I wanted to start with a fairly personal question. You grew up in a country, Peru, that suffered the effects of hyperinflation in the late 1980s, early 1990s. I was hoping that you could share some of your experiences with us.
Sure. Yeah, I was born and raised in Lima, Peru, born in 1980, and came and emigrated to Toronto, Canada in 1989. And there was a particular reason for that. The economy in Peru was in shambles at a time where our president, Alan Garcia, was making all the wrong moves, right? And I think he got elected. There's video footage of him giving out wads of money to people on the streets to get him elected. We weren't able to pay our loans. So at that particular time, 88, 89, Alan Garcia decided to default on the IMF loans, default on global loans that were offered, right? So if you think about it as a monetary policy intervention that is going to work towards reducing or making your FX rate really bad to the world, what that led to is an inflation rate in 1989 of 7,200% in 6 months. So this is, inflation rate is always high in Latin America. It's not, the issue is not when it's high and consistently high. It's when it goes from 20% to 50 to 100 to 2,000 and so on. And this is what we experienced. From a personal perspective, I was just talking to my father and my two older brothers who were 7 and 8 years older than me recently about some of the experiences that we had. And my father told a story about our grandfather, who was an accountant his whole life, had saved enough that was an equivalent amount of $1 million US. And he was given the option of keeping that in Peruvian soles or dollars. He chose soles because that's what he spent in. Within 6 months, that went to zero. And what was sad about that is that he apparently had written letters to his family saying, this is what happens when you work hard and you save, and you will never have to worry about me. In 6 months, of course, we all had to change our tune there, and we had to help him out for the rest of his life. At the same time, our next door neighbor had been given a letter of eviction for his house because he couldn't afford to pay his mortgage payments. Now, a lot of mortgages are in US dollars, right? And so or at least you pay them in US dollars. And what had happened was at the end of this period, the next door neighbor who had a lot of debt was able to pay off his mortgage with a couple $100 that he had under his mattress, right? So it was denominated in soles, but he was paying in US dollars. It was easy for him to get off of it. So what's interesting about a hyperinflationary period is that debtors win and savers lose. And I would expect, we're seeing a lot of that in recent years.
It's interesting you say that debtors lose, and we live, well, in North America, at least Canada and US, these are, people, the average person is fairly indebted at this point in time. So that raises an immediate alarm. The latest figures out of Canada and the United States are not nearly as high yet as they were in Peru at the time. Canada's central bank just announced this morning that inflation is currently at 4.7%, which is well above the bank's target rate of 1 to 3%. And that's actually the 8th consecutive month that it's been above the target. So definitely a trend there. And the United States, just announcing the latest figure, is 6.8%, up 6.8% from last year, including the cost of gasoline and food prices. Again, well above the target numbers. Is it fair to say that the central banks and, along with a little help from the government, have lost control of the inflation situation currently?
The thing about inflation is that people tend to think that this is this dial that we can kind of dial in. You get too hot, you get out of control, it gets too cold, you kind of move it the other way so that you can get it down to 1%. My experience examining Brazil, Peru, US in the 1970s is that, nobody has control over inflation. And not even us, like as pundits talking about what may or may not happen. I don't know if they've lost control. They never had control. Inflation is going to happen, and actors are going to act in ways that's going to suit their needs at the time. And it's the confluence between the three major levers of inflation, which is supply chain issues, so supply side, supply pull inflation, whether it's monetary policy or whether it's demand-led inflation. All these things are working together that will ultimately decide whether we're going to have a deflationary bust from here or a massive inflationary continuation. So certainly what the Fed government and the governments around the world have done in their side of that third lever is not helping the inflation situation. And they could easily get out of control here if it goes down a negative cycle for where the monetary issue is the thing that dominates.
I think that's a really interesting comment, because when you listen to comments from the Fed or from a government official, whether it be Biden or Trudeau or another politician, they always seem to, their remarks always seem to give you the impression that they do have control of the situation. And so it's, I think you're absolutely right that they don't always have control of that dial. And if they did, they certainly wouldn't miss their targets for 8 months in a row. I mean,
well, think about it, right? Control and dialing in and dialing out means you go from 1% to 2% inflation. You don't go from 1% to 7. You don't go from 20% to 7,000 in Peru, right? That's a third world country. But in the US in the 1970s, you saw the purchasing power of the average American get cut in half in 6 years, right? So these are modern economies. We see it over and over again that articulate that they have some sort of control over things. And there are blunt instruments that you can take in order to mitigate it if you have enough political power to turn the ship around. But this idea of dialing it in is just it's a non-starter. It's always jumpy. And the thing about inflation is that it's also not just consistent and persistent. You have these moments of jumps and then massive deflation, and moments of jumps and massive deflation. So it's the next decade is what I think we're going to see is inflation volatility rather than just inflation perpetually.
And what does inflation volatility mean for Main Street? What does the average investor need to prepare for? What are the impacts on their day-to-day lives?
Well, I think you need to prepare for something like this, right? When we say things like inflation's up 6%, what that actually means is that the basket of goods that you were able to buy a year ago, you are now able to buy 6% less of that basket, right? It's a big impact. And so, especially for individuals that have no ability to increase their wages, they're going to be in trouble, right? It's investors, especially today, where 40% of their portfolio is in negative yield territory, and inflation just went up 6%. You're not getting anything from 40% of that portfolio, right? So investors and maybe people that don't have investments that depend on some sort of pension plan, they're the ones that are going to struggle the most. But in anything, it's not going to be necessarily persistent every single year. There might be moments of reprieve where we have the supply chains clearing out and, growth at a higher level than we expected, where the Fed starts increasing interest rates, and we might have a moment where that inflation bubble bursts a little bit, gives some reprieve to the investor. But generally speaking, what it means is that there's a lack of planning for a saver, for a consumer, and for businesses, right? So it creates a level of uncertainty that's never good for anybody, consumer or business owner. And we see that reality. I lived through that and know people in Peru that continually live through that, especially Argentina and Brazil. Forget it, right? There's just no consistency. And that's a terrible thing to offer the market.
Absolutely. Yeah, it's well documented that wages lag against inflation. And I was just looking at the numbers out of Canada. They said wages are only up 2.8% thus far. So you are losing purchasing power in real dollars at this point in time, especially concerning, like you said, for certain segments of the population. So the next question, logical question, Rodrigo, and thank you. Excellent explanation of inflation and what we can expect it to do. What can investors do about it?
Well, I think that what's important to understand is that modern portfolios are not fit to deal with inflation volatility. Okay, I want to emphasize inflation volatility because it's not just inflation, it's ups and downs. I mean, the average portfolio has bonds in their portfolio, which aren't going to do well in inflationary regimes. and equities in their portfolio, which depending on the equity market you're in, you may or may not do well. So what do I mean by that? You have a period like the 70s where we had stagflation. What that means is that we had supply side inflation issues that led to economic collapses. We had a couple of bear markets in the 70s and the late 60s, mid 70s that led to both recession and inflation at the same time, right? So equity markets in that environment where we just can't produce, businesses can't plan, it's too costly to produce things, and consumers aren't there. Your bond and your equity portfolio are just going to be flat in real terms. And for that decade, the 60-40 portfolio returned $0, right? In the 2000s, it was different because you had an inflationary boom period where it was led by a US dollar in decline. And during that period of US dollar decline, what you saw was emerging markets really being able to take advantage of that purchasing power, the commodity-driven economies especially, able to transfer the pricing, really add to their coffers in a period where energies and basic metals and the like were actually doing really, really well. China was growing, it was the BRICS period, right? If you recall, in the early 2000s, Brazil, Russia, India, China. In spite of all that, the best place to be was still commodities, right? Just the pure basic commodities, the golds, the energies, and the like. And so in the 2000s, the equity portfolio, did okay in periods of the 2000s. Of course, we remember the tech crisis and the credit crisis, but there were periods there of magic. Regardless, if we go through either one of those periods, you are better off dealing in the commodity side of the business, right? So you need to find a way to add thoughtful exposure to commodities in your portfolio. It could be, and there's also the risk of hyperinflation, at which point I highly recommend like a physical gold or silver positioning so that you can have it there just in case. But from a liquid portfolio perspective, those periods tend to be of high volatility inflation, tend to have really strong trends up and really strong trend down, where you would benefit from an active commodity manager that can take advantage of both the long end and the short end of the portfolio, right? So that is absolutely crucial. And I can share my screen to show you what I mean by that.
Please go ahead.
And really highlight some of those years, right? So let me make sure I got the right screen up. All right, so here we go. So what's interesting here is this is the period of inflationary boom, okay? This is a time where the yellow line represents a passive commodity index. This is the Deutsche Bank commodity index, okay, in yellow. And from 2000 to the peak of the commodity crisis, commodity boom period was February 2011. What you notice here is that if you just bought let's say a portion, 10, 15, 20% of your portfolio to commodities, you did indeed benefit from being in a inflation-sensitive asset class as a long-only portfolio, right? So that's the yellow here, in contrast to S&P 500 in the bottom here in dark blue. The problem here is that from 2000 to, there was a period here, like an 18-month period where you lost 37% in commodities. And of course, you had the credit crisis that led to a 60+% collapse in commodities, right? It quickly turned it around. My point is that in this inflation volatility, you're going to give up on the periods of deflation. Instead, when you look at things like macro, or what we do is risk parity with macro stacked on top, or CTAs or trend followers that deal in the commodity space, what you're going to find is that they can navigate these markets fairly well. Upward sloping when the markets are down, upward sloping when the markets are down here. And so if we're going to be in a period of high inflation, volatility, and we want to be able to protect our portfolios, you have to be able to protect it from both the high volatility and down volatility, and have an ability to be nimble with the long and the short end, right? This is the last inflationary boom cycle. When we go back to the 70s, it's a similar idea, right? The 70s, people talk about how, the best place to be was commodities. Gold was, I think, was up 1,400% for that period. Commodities in yellow here, it was up 800%. But again, you saw a 3-year period of a 37% correction where you just would have given up on that position, right? So again, we're looking at active ways to go long and short these things. In this case, the blue line represents it comes out from a paper from AQR, looking at the Futures Diversified Trend Index that can trade long and short commodities, long and short equities and bonds. And you can see that it does a good job at offsetting inflation while also mitigating that drawdown. From a risk parity perspective, similar idea, the black line here, right? So these types of strategies are going to fare really, really well in inflationary regimes and are going to drastically underperform in disinflationary regimes. So don't expect these strategies to really be there for you in a time when equity markets are going to be crushing it. In a disinflationary period, a strategy that runs over 50% of the securities that they trade in are commodities, they're going to not do well in a chopped up environment, right? So the last slide here is from February 2011, so the peak of the commodity cycle. Yellow again is commodities. This is what happens in a passive commodity. If you have that in your portfolio, you just had flat, then it went from that was an almost 60% drawdown, if not more, then flatline for a long time. And only recently have we seen some benefit. You're just not going to be able to stick to that, right? Contrast that to an active strategy or a risk parity where it didn't do as well as the S&P, because that's not what these guys are designed to do. And it's been a disinflationary period, so that hedge isn't going to really kill it, but it's going to do okay. And you're not going to give up on it necessarily, right? So I think this is it. Out of all the options I'm looking at, tips on their own, maybe not, maybe a small position in tips, get some physical gold and silver. But then for your liquid portfolio, find a good long short commodity strategy, preferably systematic, like the ones that I'm highlighting here. So that's the answer to that. And I think we're in a position uniquely for this type of environment if we do see it. And if we don't see it, well, then you're going to have an okay period for it all.
And I'm assuming this is a service that your firm offers, Rodrigo.
That's right. So we depending on the audience, we have an ETF that we just started running for Horizons ETFs. Ticker is HRAA, and that one is risk parity plus systematic global macro long short, right? So just basically the ability to go anywhere. And that this year, most of the returns for that fund came from the energies and grains and metals side. It can invest in equities, but again, it's going to do okay in periods of disinflation. I think it has the potential to outperform during periods of inflation without those big drawdowns. In the United States, we sub-advise a fund for rational funds that does a similar thing. And also for, accredited investors and institutions, we run private pools at higher levels of volatility in order to provide true, high volatility when you need it the most, right? So that's for accredited investors. We're in a couple of hedge funds in there. So yeah, I think, I got into the business. We met Mike and Adam and started the business in 2011 because I saw the light, right? I saw the previous 10 years thinking this is going to be fantastic. And we led into a period of disinflation, right? So we then spent 10 years building something to prepare for the next 10 years. And I think it's going to be pretty good for us, and hopefully we'll be able to help a lot of people on the inflation side.
Amazing. Love the information, Rodrigo. Very enlightening. I've definitely learned something personally. I'll make sure to include links to Resolve Asset Management SEZC in the link for the video. Excellent. As well as the ticker that you mentioned. And can we include your contact details for anybody?
Yeah, so we're very active in Twitter, so you can find me at Rod Gordillo P. We also run a podcast. You're invited to our podcast this Friday, right? We're going to talk about a long form podcast every Friday called Resolve Risks. We do a bunch of content. We've written over 250 articles and have a bunch of white papers that are pretty popular. So just look us up, Resolve Asset Management. Look me up on Google me, and you'll be able to see some of the stuff that we put out. But we're just trying to attack the problem from a different perspective and remind people that the markets aren't what we've seen in the last 10 years. It's what we've seen in the last 100 years. And
I love it. A different perspective. Always important to open up your mind to take a look at problems a different way, especially in these challenging times. Rodrigo, thank you for your time, and look forward to having you back.
I appreciate the invite, Mark, and looking forward to seeing you soon.